Hello, everybody. Hello, hello, hello. This is Darren from ProtectMyIncomeNow.com. I'm also an agent with American Classic Agency, and today I'm going to show you how IUL is the tax-free retirement champion. So many people know that life insurance, or so many people don't know that life insurance is the world's safest industry. What I mean by that is, here's an account that it yields 5 to 6% more than a long-term CD that you're probably invested in at your bank or credit union, and it has guaranteed returns in most cases. Does not have to be reported to the IRS. It can be accessed anytime without penalty, and it lets you retire 100% income tax free. And yet, almost no one knows anything about these plans, especially us African Americans. And why is that? Well, because number one, the government places tight restrictions on the advertisement of these products, and even though they're 100% legal. So, why do you think they do that? Well, the government places tight controls and restrictions on the advertising of insurance products because they can't make any money off of it. They don't make one penny, or they can't make one penny off of it. So, yeah, that's the reason they do that. And number two, if we sold cash value life insurance to everyone in America, there would be no tax money. There'd be no tax revenue for these guys to screw up. So I love showing people how when you put money into one of these vehicles, how it accumulates without current taxation, and when you take it out as a retirement benefit, it's paid out tax free, and when you die, the death benefit is paid out tax free. That's what I'm excited about. That's why I love this Index Universal Life. So join me now as I take you through how Index Universal Life, or the tax free champion, works. All right. Give me one moment as I set my presentation up here. Index Universal Life, the tax free retirement champion. So here's how a universal life policy works. So you go out and you purchase a life insurance policy, and you pay your premium to the company, and the company takes out whatever fees and costs in order to make their living, and the balance of your premium then goes into what is called the policy cash value. Now, there are two components to an IUL to look at. There is the bottom, or the minimum, that is set by the insurance company. That means you've got to have a certain amount of money into the cash value so the policy can stay in force, and that's what the company needs in order to be profitable, which is represented by the dark blue shaded box here with the dollar sign. Now, the top, or the lid, indicated by the dotted line, meaning the most you can put into the policy without being taxed, that is set by the IRS, because this is a really good deal for the individual, and the IRS doesn't want us to have too much of this good unlimited deal. In fact, if these limits are exceeded, the policy becomes what is called a modified endowment contract, and all of the money taken from the cash value that you've built up and accumulated becomes taxable. But don't worry, that's why we're here. We're careful to, when we're designing this policy with you, we totally avoid this for you. So you put your money into the cash value, and it grows over time, and there's three basic ways that it comes out. Number one, the most and number one is not the most attractive way. If you die, your family takes the death benefit tax free. And let me say, there is no other investment out there that has this type of benefit attached to it. Now, the second way it comes out as tax free withdrawals from cash value. And the third way is from tax free loans. And that's how we fund our tax free retirement program. And by the way, loans are not taxable income. So let's give an example. We're going to get to the good part to show you some numbers of how this thing could really work for you and lead you to the ultimate question of, is our tax-free retirement plan a better option than a 401k? All right, so let's look at an example here. We have a 35-year-old male, standard non-tobacco, 25% tax bracket. All right, so he's going to put $200 a month into his 401k. That's $2,400 a year. With these numbers, he's going to reduce his taxes by $600 annual tax deduction savings. So his taxes will be reduced that year by $600, which is very attractive, and I understand that. And again, that's the whole selling point with these plans. It's rare that someone selling these programs talks about what they can gain from the program. All they really talk about is the tax deduction. Now, is our tax-free retirement plan a better option? All right, let's take a look and see. Now, this probably looks small, so let's see if we can blow this up a bit so you can get a closer look at the numbers here. Bear with me one moment. Here we go. There. Now, so let's take a look. When I built this slide using our software to construct a comparison between what they call a tax deferred account, which is comparable to a 401k, IRA, 403b, etc. All right. So using the tax deferred option, when I ran this, I was very kind to it. I ran it at only 7% interest. So this is assuming that this account is going to earn 7% long term, and that's a pretty liberal assumption on my part. Now, we have an income tax rate of 25%. The Flex Drive shows an interest rate of 6.42%. Now, that 6.42% is the cap, the highest that we can illustrate the Flex Life policy. Now, the default option for investing in the National Life software over the last 20 years has produced a plus 10% return. A plus 10% return. And we're limited to just showing you 6.42%. So right away, I can tell you without any hesitation that this illustration understates what this Flex tax-free policy can actually do for the client. All right, so we've got $2,400 going in to the left here, all right, indicated there, $2,400. And we've got $2,400 going in to the right over here. This is our Flex Life policy. And for 20 years, I'm paying money into both programs. Notice the last column over here. This year, notice that last column, the year end account, the year end, after 1 year, we've got $2,427, and that's the death benefit. So, folks, if this guy dies after year one, his family's going to get $2,427. Now, take a look over the policy. If he dies in year one, at the end of year one, he's going to get $56,356. So, during the accumulation period, 30 years, that money is building up. And while that person is building their retirement account, should they die, the beneficiary is going to get much more money and is going to be tax-free during the accumulation period, the 30-year accumulation period. While the person is building their retirement account, should they die, the beneficiary is going to get much more money and is going to get it's going to be tax-free. So that $2,427 is going to be taxable. That $56,356, the $56,356 to the right is not going to be taxed, right? It's not taxable because it's a life insurance death benefit. Now, let's take a look at 10 years at 29,000 and some change versus $81,000, almost $82,000, right? At the end of age, let's take a look at age 30. So at the end of 30 years, I mean. So let's scroll down and see what happens. The money is still accumulating at 30 years. Boom. At the 30 years, they've got $161,000 that would have been their death benefit. But take a look over here. We've got $235,000 over here that's tax free. So during the accumulation period, there is no question that our plan is superior. But how about when we enter into retirement? Just one moment. So here we are in retirement and we start taking out 12,601 a year. As you can see right here, age 65, they're in retirement and they're taking 12,601 a year. So we use the guaranteed lifetime benefit rider, which allows you to withdraw your money tax free. So notice what happens at age 83 down here. So he's taking his withdrawal in retirement. He reaches age 83. Look what happens here. You see all those zeros? That means that his account is empty and there is no money left when he reaches age 83. Now look to the right side here at age 83. All right. 12,601 just keeps on running. It just keeps on running until age 94. It keeps on running, and we can go into another page. Age 95, 1201, 12,601 is still going, right? So we can go to age 120 and he can still take 12,601. Folks, the total distribution would be over $700,000 coming out tax free for the rest of his life. This is just an incredible comparison and illustration compared to a 401k. And hands down, our product is superior to those traditional products. So if you want to see an illustration of how this could work for you, please don't hesitate to contact me. This is Darren from ProtectMyIncomeNow.com. We'll talk to you later.